Hello, everybody. I'm Michael Plaks, and we are starting our weekly webinar on IRS taxation for realtors and real estate investors, because topic that we are covering today is actually applicable to real estate investors just as well as realtors. We are going to talk about tax deductions for business driving for use of your automobile. So let me start by briefly introducing myself in case we haven't met yet. And I'm Michael Plaks. I'm black belt in real estate taxation. My specialty is real estate and IRS deductions for real estate professionals. So what we're going to do today is talk about some specific issues and have a Q&A session after that. So I want right now to show you a couple pointers about who we are. Okay, and I'm a black belt in real estate taxation, as I mentioned. My license is a federal enrolled agent, which means I'm authorized to represent my clients in various problems with the IRS, and we have 20 years experience doing that. I'm in the tax business since 1996, so it's been 20 years. And in my tax preparation firm, REI tax firm, we work exclusively with real estate investors and realtors. As you can see on my logo, I wear those red gloves so I can beat the IRS so you don't have to. Our company has been rated one of the top 3 tax firms in Houston, Texas. And you're looking at a slide from 2014. And we are also rated one of the top 3 this year in 2017. 3 years later, we are the only firm that has been rated continuously for 3 years as one of the top 3. What it also means is if you go online and check us out, we have perfect 5-star rating on Google and on Yelp. So we would be happy to help you if you have any tax issues. What we have today is a realtor webinar. We start every week at 12 noon Central Standard Time. We record those webinars, so in case you missed one of our weekly seminars, you can always find it on our YouTube channel. And maybe you are watching the recording now, then we greatly appreciate it. We have a 20 to 30-minute presentation on the main topic, and then we always have Q&A session. You are welcome to send your questions to our email, which is right now on your slide, service@michaelplaks.com. You can also use that email to request slides of the presentation. And since you are watching this on YouTube, you have a chat option on your screen, so you can also type your questions there, and we will address them at the end of the presentation. So right now we are going to talk about something that has to do with daily tax deductions for real estate investors and realtors. We are going to talk about driving. We started by talking about what does not work when we do real estate business and we are trying to deduct expenses for driving your car. First is what we often have is that sentiment is, oh, I will just charge all my gas on my business credit card and I will deduct gas charges. Guys, that does not work. That's not how the system operates. I will make my car payments from my business account and that will be deductible. Also wrong. You cannot do that. And, oh, if I'm audited, I'm just going to explain to the IRS auditor I'm a realtor, I always drive to appointments, and they will surely understand. And I can assure you 100% that no, they will not understand that. So what we're going to do today is talk about real rules, how the system actually works, and hope that after this presentation, after our webinar, you will not make these mistakes and know how to do it correctly and maximize your tax deductions. So first, we are going to look at something which is called standard mileage method, which everybody pretty much knows how it operates, or at least heard how it operates. So what I'm going to do now is, in my experience of teaching real estate taxation for 20 years, I figured out that the best way to do it is not on slides, but to show how it works on an actual return. So what we're going to do right now is we will open up tax software, something that you will see if you are using TurboTax or some other tax preparation software. Yours will look different from mine. I use different software, professional grade software. But what we're going to do right now is look at an actual return of a hypothetical realtor and see what difference deductions for business driving make on that realtor's return, and look at some numbers and take it from there. So right now I'm going to put on my screen tax software, and we are going to look at an actual example. So what you are seeing right now is realtor tax return, and we are looking at the part of the return where business expenses and income are reported. That is called Schedule C, profit or loss from business. If you watched our previous seminar on home office, that's the same schedule which we examined back then from home office angle. Right now, we are going to look at the driving part of that. So we have a realtor who made $50,000 in commission. We are looking right now, that's on line 1 of that schedule, and we have $50,000 of business income. Off of that income, the realtor deducts a bunch of expenses that are listed here on various lines. We are specifically looking right now on line 9. That line says car and truck expenses, which is deduction for business driving. And right now that number is 9828, so roughly 10,000. So before we look how that number is computed and what we needed to enter in the software to create that number, let's see what difference it makes on the bottom line. What we can see right now, if we look at the results, is that realtor owes $5,000 to the IRS on the entire tax return, and that $5,000 is computed as $50,000 income. Then she had $30,000 worth of $20,000 worth of expenses, which include roughly that $10,000 of driving. So we have again $50,000 of income, $10,000 of expenses for driving, $10,000 of other miscellaneous expenses, and the resulting net profit, meaning is income after expenses, is $30,000. Again, on that $30,000, the realtor owes the IRS about $5,000. What we are going to do now is, let's imagine there was no driving. What I'm going to do, I'm going to temporarily remove that number. I'm just going to put 0 instead and see how numbers change. So right now we have 40,000 income instead of 30. And if we look at the bottom line, our 5,000 tax liability jumped to almost 8. So that deduction saved the realtor about $3,000 actual cash in her pocket. So we're looking at $3,000 in our pocket. A little bit less if you look on exact numbers, but number will vary depending on your situation. It depends on how much income you make on your business, how much deductions you have, your overall financial situation. Do you have another job? Do you have a spouse with a job or a different business? You have kids, you have your own home with mortgage deductions and stuff like that. So that number will vary. We cannot always correctly estimate the exact number, but we can have a guess. And our guess again will be here. Our 10,000 deduction for driving saved us 3,000 hard cash in our pocket. So right now I'm going back, removing my temporary override. So we are looking at the 10,000 right now. I want to show you what's behind it, how that 10,000 came about. We had to report to the IRS what vehicle we are driving. So I put as an example Toyota Camry, which we started driving at the beginning of last year on January 1st. And we need to report 2 numbers to the IRS. One says how many miles we put on our vehicle for 2016, everything included, personal, business, whatever. And that number that we put in my example was 24,500 miles, out of which we say 18,200 miles were driven for your realtor business, which produces about 75% business use. More or less standard for full-time realtors. Numbers look realistic. In fact, those are numbers from one of the actual returns that we prepared. So here we are at 24,000 and 24, I'm sorry, at 18,000 business miles, and at 18,000 business miles turned into 10,000 business deduction. So again, we started 18,000 miles, got approximately $10,000. You can roughly say that we cut that number in half. So 18,000 miles, if we divide it by half, would be 9,000. So we're pretty close to that. So we divide number of miles by half and we get 9 or 10,000, like in that neighborhood, number that gives us a deduction. And then roughly 1/3 of that is what we save at the end of the day, we put in our pocket. So again, 18,000 miles, about $3,000 in our pocket. So if you want a very rough rule of thumb how you can estimate it, as you can see, take number of miles and divide it by 6. So you will get approximate numbers. 18,000 miles converts into $3,000 savings when the dust settles, give or take. So, and here you show how accountants do math. When accountants do math, I divided 18,000 by 3 and arrived at about 6. So you can see that every step of the way, when we are doing those calculations, I use very rough estimates, very big approximation, just so we can have some rule of thumb numbers to work with. So again, we take 18,000, divide by 6, and we arrive at approximately 3,000 miles deduction. So this is how that standard mileage method works. Question is okay, what do we do with all other expenses? So what happens right now with everything that we pay for? What happens with gas? What happens with insurance, repairs, tires, whatever we have to pay for when we operate our car? Also, what happens with purchasing that car? When we pay money for the car, whether we paid cash and bought it all for cash, or we have right now an automobile loan, so we have monthly payment, where all of these numbers go? And the answer is they don't go anywhere. The beauty of that standard mileage method is we don't have to worry about that. There is one number for absolutely everything, and that number is mileage allowance that IRS gives you. I'm going to show you right now, we're going back to slides, and I'm going to show you some of the rules, how that standard method operates. So what we are looking at is, first, standard mileage method. We saw in the example that 18,000 miles produced about 10,000 worth of deduction. This is how it was calculated. Every year IRS gives you a number, standard allowance, how many cents per mile you get to deduct. For 2016, it was 54 cents. Somehow for this year, IRS reduced it by ½ cent. Why, I cannot tell you. They do those calculations, I guess, based on the current cost of gas, averaged across the nation, whatever else they take into consideration, but that number fluctuates from year to year. In the last decade, it was always around 50 cents. So if you use tax software or an accountant, obviously correct number will be automatically applied. If you want to estimate, use 50 cents per dollar and you will get pretty close. There are two more things. I said everything is included with two exceptions. First exception is if you are making payments on that car and you pay every month, let's say $400 for the car, part of what you are paying is interest. You can take interest portion and part of that will be deductible. I will show you that on the tax return example in a second. One other thing you can add would be tolls and parking that are used for your business. Just tolls and parking and portion of your interest, nothing else. Next line says absolutely everything else is included, meaning is the actual car payments, gas, insurance, repairs, maintenance, whatever else you have to spend. We're going back right now to look at the example. So I want to show you where that interest goes on tax return. So on that same page where we were entering expenses, if we scroll a little bit down, there is an area which allows us to put business tolls and parking and a portion of business interest. So right now it says business related parking fees and tolls. So let me put $100. And as you can see right now, number that used to be $98.28 just jumped up by $100. And let me put interest on vehicle of $1,000 for the year, just to show an example. So once I put there, we would expect the number jump up to $10,928. That will not happen. It jumped to a smaller number. Why? Because it applied business use percentage. What happened when we entered mileage was we said total mileage for the year were 24,500, but only 18,200 of that was for business. So that's 75%. So everything that the software calculates according to the IRS rule will be 75% of your total expenses. So we have that business interest of $1,000, but only 75% of that was included in the number. So what we have right now is our total expense went up, our total deduction, because we added business-related fees and tolls, and we added interest on vehicle. Nothing else will really matter. Well, if you see on the screen, one other thing would matter is property taxes, including property tax portion of registration. That is a small convoluted deduction, but yes, that's another one of the exceptions that you could use to bump that deduction just a little bit. And as I mentioned before, everything else would be included in your calculation, will be included in that 54 cents per mile IRS allowance. So we are done as far as creating tax return. We are not done discussing IRS rules and what happens in that situation. So we need to look right now and see is, okay, besides entering that information, what else is required? What are additional things to keep in mind? So let's go back to slides and look more on, talk a little bit more about the rules. First is, okay, when we counted 18,200 miles, what counts, what does not? What counts is kind of easy. Everywhere where you drive for business, which is all client appointments, driving clients around if you use your car for that purpose, going to open houses, going to any kind of business meetings, including business meetings with your accountant, attending classes, conferences, business shopping, meaning is, okay, if you need to go buy some office supplies or technology for your realtor business, all of that will count. Next question would be then, what does not count? Because that seems to be everything. Well, obviously anything personal doesn't count. So you cannot include miles that you spend doing personal shopping, recreation, taking your kids to school and after school activities, that kind of stuff. You cannot count miles that are spent in non-realtor business. If you have any other business, for example, if you are also an investor and you have portfolio of rental properties, those miles will be deductible, but they will be deductible in a different place, the place where you would report your rental properties. Right here on the realtor schedule, only realtor-related miles. And now we come to a very unfriendly IRS rule that trips a lot of people. What you cannot deduct is what the IRS calls commuting. Commuting to from the office. What the IRS calls commuting is if you have to go from your home to your regular place of business on a regular basis. Doesn't even have to be every day, but on a regular basis. So let's say if you have your broker's office and you need to go to that office 3 times a week, like every Monday, Wednesday, Friday, to give you an example. You must go there every morning where you attend some kind of a meeting and then you go to your appointments. Your driving from your home to your broker's office will be called commuting by the IRS, and those miles will not be deductible. Before you say some choice words about that rule, we need to talk about one exception, which I will show in a minute. But before we talk about that exception, I also want to mention something that we frequently get asked. Well, my car has a magnet on its side which says, John Smith, best realtor in Houston, my phone number, my website. So every time I drive, I'm essentially doing marketing because my contact information is on my car. So every time I drive, this is advertising. Guys, nice try, good thinking, but it does not work. That argument will not work. Those miles are not allowed. Driving your car for personal reasons does not become deductible just because you have your business advertising painted or attached to your car. So keep that in mind. Now back to commuting. I said there is an exception. That exception has to do with a loophole related to your home office. All business-related trips will count if your home office is your principal place of business. We talked about home office in a previous webinar. If you missed it, please check it out on our YouTube channel. It was recorded, it's there. And principal place of business in the home office means that can you have principal place of business in your home if you have an office at the brokerage? Yes, you can. There are some requirements that we discussed in our home office webinar, but basically you would need to use that place for significant administrative activities, such as your bookkeeping, making your calls, returning your messages, creating your proposals, and doing all kinds of paperwork. Or if you meet your clients at your home office, that would also qualify. So having home office is double important for realtors. You get deduction for home office, and it also opens up more mileage deductions, because if your principal place of business is in your home office, that even your first trip from home to your broker will be considered deductible business driving. Next, of course, IRS wants documentation, and we see that those two words that everybody hates saying is mileage log. Yeah, nobody likes mileage log, I understand, but after that it says in black is required. Here are 4 components for every trip that the IRS will ask you for: date, where you went to, how many miles, and don't forget number 4 will be business reason. So for every trip you have to record when, where, how far, and why. Those 4 things are very important. And next question is, well, do I have to? Simple answer is that I mentioned when we started our webinar, my license is an enrolled agent, which means I represent people who have IRS problems, including audits. So during my 20 years of business, I represented a lot of people in IRS audits. I can tell you guys from personal experience. This is the first thing that you will hear from an IRS auditor if your realtor business is audited. First question will be, can I see your mileage log? Guess why it's their first question? Exactly, because nobody has that mileage log prepared. It's an easy, low-hanging fruit for the IRS to pick up. It's very easy for them to throw it out. All they have to conclude is you don't have mileage log. So guys, don't take it, don't dismiss that. Mileage log will be a major problem if you are audited. Also, IRS auditors, keep in mind, nowadays know how to check mileage online. So if you are making that log and saying is that the distance from your office to your appointment was 27 miles, IRS auditor will go on Google and figure out that it was only 12 miles. So don't do that stuff, please. Also, remember not just how far your trip was, IRS will ask what was the business purpose. So for each trip that you are claiming on your return, you will need to explain to the IRS why you went there. Was it a client appointment? Was it an open house? Was it meeting with somebody related to your business? Every trip will have to have a business purpose explained, and meaning if you are audited, in writing. I want to show you something interesting that you may not realize happening on the IRS return when you complete it. If you look at the return itself, if you look at the question they ask you, there are two check boxes that says, is there evidence to support a business use claim? If yes, is the evidence written? Translated, what they're asking you is, they're asking you, well, do you have mileage log and is it written? Are you ready to present it? If you say no, you kind of inviting them to audit you. If you say yes, you better have it when they do audit you. So difficult situation, how you go about it? Well, you do keep mileage log. How do you go about mileage log? How in the past it was a big problem and understandable hassle. Right now it's not. We all carry our smartphones. Smartphones have apps. They have built-in GPS. You don't have to measure anything. You just have to click button when you start the trip and click it second time when you arrive. Which app do you use? I cannot tell you which because offerings of apps change all the time. Go in your browser right now and just Google something like mileage tracking application iPhone or best Android app for mileage tracking. Google something like that and you will find several articles where researchers compare different apps. You can read those reviews and pick the one that works for you. Couple tips from me is, first I'm saying is beware of free apps from unknown authors. There are a lot of apps that look slick that could have been created by some guy couple oceans away from us, and that guy by tomorrow may decide that he is no longer interested in his app and he decides to do something else. Why we care? We care because the IRS audit might happen 3 years from the time we record the mileage. So 3 years from now, that app must be downloadable. You have to be able to download that data. And the application has to be alive 3 years from now, which means is, if you are using application which is critical for your business, like anything for bookkeeping, including mileage log, you need to pick app which has good reputation and is backed up by some large company that is going to be in business time like 3 years from now when you really need it. Now, next slide talks about actual method. We are going to look at something else because up until that point, we talked about mileage allowance. Simple method, but even though it's simple, we spent half an hour talking about different details about that method. The other method, actual, is more complicated. No, it doesn't mean that we're going to spend an hour talking about it. I'm only going to show you a few pointers about it. But if you watched our home office webinar, in home office, we had a very similar situation. There is a simple allowance, simple method, it actually was called simplified method for home office. You just got $5 per square foot of home office. Then there was traditional complicated method where you record every expense. Guess what? Mileage is similar. We have this simple method, mileage allowance, that we just looked into, and we have that actual expense method. What it means is, here you will keep track of everything you spend money on, meaning is your car payments, your gas, insurance, repairs, maintenance, oil changes, everything that you did to your car. And there will be a different calculation. Let's look at this example. Let's actually see how it looks on the form. That same worksheet that we looked at, if we go down, I put here expenses for gas, oil, repairs, insurance, and on that actual return, that's actually a return from a real client, at $6,500 worth of expenses. $75 were paid for annual vehicle registration, so that's $600 of different expenses. Let's look here. Remember, we had business use percentage. So the way that method works is, if we have 75 or 74% business use right here, we would be entitled to 74% of that amount. And that amount was 6527 plus 75, so 6,600. If we take that amount and take 75% of that, you can quickly see it will be way below the 10,000 deduction that we get from standard mileage. However, what else we can add is something that is called vehicle depreciation. If you are a real estate investor and have rental properties, you are familiar with depreciation. Depreciation also applies to business vehicles. The way it works is whatever you paid for the vehicle, you get to deduct over a number of years. So let's see how it works here. I entered for this example that our vehicle cost $30,000. Well, the depreciation for the car, if you look IRS rules, it will tell you that it takes 5 years to depreciate that, which if we take 30,000, divide by 5, it should be 6,000. Unfortunately, no. There are special limits that IRS sets for depreciation. And for automobiles, for regular passenger vehicles, what happens is there is a limit, 2348. How the IRS figured that out, don't ask me. It's the software that tells me right now that the IRS calculation will be 2348. Believe that number, it is correct. So out of that 30,000, you can deduct only 2348. Not a whole lot, because if we go back and see what it does, we had actual expenses, we had a depreciation of 2,300. So we had 66 actual expenses. We took 75% of that, which is 49. Added depreciation, and we have 7,200 worth of expenses. Look below. It says standard mileage 9,800, actual expenses 72, including depreciation. Clearly, standard mileage is better in this case. Next question is, can we do better on depreciation? Yes. If it's a new vehicle, and I assume that was a brand new Camry we bought for 30,000, currently there is a temporary provision, and I stress temporary because that law is not permanent. It can be removed anytime. Traditionally, Congress has been extending that benefit, but it was not there forever. It was just till the last few years that it may expire. But currently we have something which is called bonus depreciation. If I click that box, our limitation jumps up to 8,000. So we can actually take 8,000 depreciation for a new vehicle in 2016. So what it does is now our actual expenses with increased depreciation in 13,000 as opposed to 10. Now we are clearly ahead. Actual expense method with that special depreciation boost created 13,000 deduction, which is definitely better and creates additional savings in our pocket. So let's look at more rules, not more rules, at some basic rules that have to do with this actual expense method. So we are going back to our slides and looking at actual expense method. First is to use that method, you must track every expense, gas, insurance, repairs, everything. Two is you still need mileage log. It often confuses people saying, why do I need mileage log? I kept expenses. Maybe you remember why. Mileage log gives you business use percentage. That's the number that you have to have mileage log for. So because of mileage log, you determine that you drove with 75% for business. No, you cannot just come to the IRS audit and tell the auditor, I'm a realtor, I drive 75% or 90% or 60% for business. Their next question will be, prove it. Prove. And how you prove it? Mileage log. Once you have that number, then you apply that business use percentage to every expense. What we just saw in the example, that actual expense method may or may not produce better result for you. How do you know? Unfortunately, there are no rules of thumb. You have to compare both methods. And talking about that, I want to tell you what I always tell my clients. When you do any kind of purchases for your business, including a car, buy what you need for business, not for tax benefits. Why so? Because there are certain tax traps with actual expenses that people are, that realtors and other business people do not realize exist. For example, we just saw that depreciation is limited for regular passenger cars. Can it be better for some other type of vehicle? Yes. It can be better, for instance, if you buy large SUV. Let's say you decide, since you are showing your houses to families, you need a bigger vehicle, and you go buy Ford Expedition. That is a heavy vehicle. Its weight has to be more than 6,000 pounds, which Ford Expedition would be. So you have better depreciation, but it's still limited to 25,000 first year. Next thing is, once you start that method of actual expenses, you are not allowed to switch back to mileage. You cannot do actual expenses 1 year and then mileage next year. It's not allowed. Once you start actual, you stay with actual. Why is that important? Because when you start that front-loaded depreciation in the first year, you rob your future years of those deductions. What happens is in the year 2, 3, 4, 5, in those years, your deduction will be much smaller. And possibly now your actual expenses will dive below standard. But you cannot say, oh, wait a second, now I'm lower. Now I want to use mileage. No, it's a one-way street. Once you chose actual, you have to stay with actual, even if it does not benefit you later. If it only benefits you first year, you are stuck with this method once you elected it. Finally, if you do a lot of depreciation and people do some creative strategies for depreciation of vehicles, they are available, but people tend to forget that it can backfire when your car is sold. Example is, let's say that you bought a vehicle which you use 100% for business, and you found a way to deduct 100% of that in the first year. Is it possible? Actually, yes, it is possible. You can do that. So if you have 100% business use, you bought 40,000 vehicle, you deducted 40,000 in the first year. We're not talking about how it's done, but with certain vehicles, it is possible. Let's say that it was a full-size truck, heavy truck, like you bought F-250 and you are driving it 100% for business. Can you deduct 40 grand? Yes, you can. Problem is, if 2 years later you sell that truck for 20 grand, now you have 20,000 of taxable income. And people think, why? I didn't make any money. I bought it for 40, sold for 20. No, you bought it for 40, you deducted 40. So when you sell it for 20 later, now you have 20,000 of taxable income. So it's not that simple. What it means is, as short advice about it is, am I saying that you should stay with mileage method all the time? No, that's definitely simpler, less hassle, less problems, but sometimes actual method is better. Everybody decide for yourself. If you want to keep track of every expense and compare both methods, you are certainly welcome to do that. Sometimes you will come out ahead. But in many cases, you will not come out ahead over several year period of having the vehicle, or you may not even benefit number-wise from taking that deduction even in the first year. So it's somewhat of a gamble. You decide which method you want to implement. And that is that concludes our official presentation. We are going to take questions right now, and I'm going to answer questions that we have from people who are watching this seminar live. If you are watching this in recording, then you can still send us questions, but those questions will only be answered through our regular channel, meaning is on our website. Our website is michaelplaks.com. As a reminder, we are in tax business since 1996, work exclusively with real estate investors and realtors, and we'll be happy to help you anytime you have tax questions or need tax return preparation. If you go on our website, what I strongly encourage you to do right now is subscribe to our newsletter, because all IRS updates, all our blog posts, all new videos are distributed through our newsletter. So please go right now on michaelplaks.com, join our newsletter if you have not done so, and we will see you again in a week on our next webinar.